In July, 6 weeks before the year end, we make a sale, we deliver goods to a foreign customer. That foreign customer has a currency in the krona. Now, the agreed value of the sale is 40 million krona, and this is our hedged item. This is our risk, because the risk is we're not going to get as much money as we might think if the exchange rate deteriorates. So in July, we hedge. We enter into a contract to sell the krona for $23 million, and this contract was entered into at no cost, and this has been designated as the hedging instrument. Because exchange rates have fluctuated, the value of the currency contract is now worth 1.5. The draft accounts don't include any amounts in respect of this because it had a cost of 0, but do recognise the exchange loss of 1.4 on the retranslation of the debt. My hedged item is a foreign currency debtor. My hedged item is a debtor in a foreign currency. What do you do with a debtor in a foreign currency? You retranslate it because it's a monetary item. Did we have a gain or a loss on the retranslation? A loss. And where did that loss go? P&L. Now I've entered into a derivative. The derivative is going to give me a gain. Yeah? Now because the derivative gives me a gain, I'm wanting to marry the two together. I'm wanting to offset the two together. So I have a fair value hedge. The asset has fallen in value, the loss is in the P&L, the derivative has risen in value, so we take the gain and we also put it in the P&L, and they get married. They get offset, they get paired, and that is beautiful, and that is instant hedge accounting. This is a fair value hedge. So, let me go through the answer with a little bit of structure. The hedged item is the foreign currency receivable. The hedged item is the foreign currency receivable. This monetary asset is retranslated. This monetary asset is retranslated at the closing rate. The exchange loss, 1.4, is recognized in P&L. So the hedged item is the foreign currency receivable. This monetary asset is retranslated at the closing rate, and the exchange loss of 1.4 is recognized in the P&L. Full stop, leave a space, new paragraph. This is a fair value hedge. This is a fair value hedge. As the risk relates to changes in the fair value of the recognized asset. This is a fair value hedge, as the risk relates to changes in the fair value of the recognized asset. The currency contract is the derivative which must be at fair value. Full stop, leave a space, new paragraph. The currency contract is a derivative. It must be at fair value. So the currency contract is a derivative. It must be at fair value. The gain of 1.5 is matched with the loss in P&L. So the currency contract is a derivative. It must be at fair value, and the 1.5 asset gives you a gain of 1.5, and this is matched with the loss in P&L. This is matched with the loss in the P&L. So if you want a little extract, if you want a little kind of story, I suppose, in numbers, if you want to have a look what would happen, then in your profit and loss account, let's see what numbers you would have. In your profit and loss account, you would have an exchange loss, and the amount of the exchange loss is 1.4, but then you would have a gain on the fair value hedge, and the gain on the fair value hedge is 1.5, so you would have a net figure there of 0.1. And in your statement of financial position, you would have a receivable which had been retranslated. And I'm assuming that would have been 23. And you have got a loss on that of 1.4. So you've got a receivable there, presumably of 21.6. And then you have a derivative at fair value, and that derivative is at fair value at 1.5. Hedging is a risk management process. Hedging is a risk management process. Hedging means to identify that you have a risk, a hedged item, that you have assets or liabilities or commitments that can go wrong. They can be to do with borrowing money so that you've got a cash flow risk if interest rates go up. It can be to do with foreign currency balances, exchange rate risk. It can be to do with price risk, because if you're always buying oil, or you're always buying dollars, or you're always buying something, there is a risk that that commodity price could go up. Some companies let it roll, some companies don't bother. But if you are wanting to proactively manage your risk, you can do so. And proactively managing that risk means taking out a hedging instrument. A hedging instrument is designed to create the opposite effect of your hedged item. So if your hedged item gives you a loss, then your derivative will give you a gain. Now the accounting for the derivative has to be at fair value. If the hedged item is a fair value hedge, to do with an asset or liability that's throwing up a gain or loss straight away, then you can match it together straight away. If, however, the derivative relates to future transactions, future cash flows, then you're going to have to hide it away in other and recycle it back to the profit and loss. Let's have a look at another example. Let's have a look at page 163. Let's have a look at beta. Page 163, beta. Beta. Explain and illustrate the accounting of the above. Beta has a reporting date of 30 September 14. Six weeks ago, it decided to buy some materials next year. It decided to buy some components next year. Now, the agreed value of the order was 25 million crown, and the goods will be delivered and will be paid for and will be executed in next year, not this year. So we've got this commitment for a future transaction, and we've entered into a derivative to fix the price at $13 million. The directors of Alpha have designated the currency contract as the hedging instrument. Fluctuations in the currency are that the fair value of this contract is 2.5, which is a financial asset. The draft accounts don't include any amounts in respect of the currency. The directors have estimated the currency contract is a perfectly effective hedge. So that's good news. So what we've got here is our hedged item is not a recognised asset and is not a recognised liability. Our hedged item is a commitment to pay for these goods in the future. We haven't yet bought them. So we haven't got the inventory, we haven't got the payable, what we've got is a commitment. So we have a cash flow hedge. So the gain on this derivative is going to be taken to other, when it will be recycled to the P&L next year. You recycle to the P&L next year. So here we are. Yeah, the hedged item is the future transaction. Is the future transaction. The commitment to pay £25 million. no exchange gain or loss arises as it is not a recognized liability. As it is not a recognized liability. So the hedged item is the future transaction, the commitment to pay 25 million crowns. No exchange gain or loss arises as it is not a recognised liability. This is a cash flow hedge, full stop, new space, new paragraph. This is a cash flow hedge. This is a cash flow hedge. As the risk relates to changes in future cash flows. As the risk relates to changes in future cash flows. So this is a cash flow hedge. This is a cash flow hedge. As the risk relates to changes in future cash flows. A currency contract is a derivative. A currency contract is a derivative. A currency contract is a derivative. It must be at fair value. A currency contract is a derivative. It must be at fair value. In this context, the fair value is 2.5 million. Asset. A currency contract is a derivative. It's a hedging instrument. It must be at fair value, 2.5, asset, and the gain is recognized in OCI. The gain is recognized in other comprehensive income. And will be recycled from equity to P&L in the future. So you've got a cash flow hedge. There is no instant matching because what we're hedging is a future transaction. What we're hedging